Something doesn't add up. Inflation comes in hotter than expected. The number lands at 3.8%, above the Fed's target, above what the market anticipated. And gold, the metal that has served as humanity's oldest hedge against exactly this kind of monetary erosion, falls. Not slightly, not a rounding error, it falls. And the financial media shrugs. They move on. They give you the surface reading, the chart with the red candle, and they cut to the next segment. But if you've been watching this market for any length of time, if you've ever studied what gold actually does and why it moves, you know that something in that picture is deeply, structurally wrong. So let's slow down. Let's actually think about this. Because the story of why gold fell on a hot inflation print is not just a story about one metal on one day. It is a story about how modern financial markets actually work, about who moves prices and why, about the difference between the gold that exists on paper and the gold that exists in the world, about central bank behavior that is hiding in plain sight, and about what all of it means for where we are headed. This is the story they are not telling you. Let's start with the basic logic, the version they teach in every introductory economics course, because it matters that we understand it before we dismantle it. Gold, in the traditional framework, is an inflation hedge. When the purchasing power of a currency declines, when a dollar buys less bread, less gasoline, less of anything, gold is supposed to preserve value. It cannot be printed. Its supply grows slowly, constrained by the physical limits of mining the earth. And so when a government inflates its currency, rational actors are supposed to rotate into gold as a store of value. More inflation equals higher gold. That is the relationship that has been taught, believed, and repeated for decades. So when inflation prints at 3.8%, still running well above the 2% target that the Federal Reserve has been claiming as its North Star, the textbook says gold goes up. People see currency erosion. They buy the hedge. Price rises. Instead, it went the other way. And here is the first thing they are not telling you. In modern financial markets, gold does not primarily respond to inflation. It responds to real interest rates. Specifically, to the relationship between nominal interest rates and inflation. That gap, that spread, is called the real rate. And it is the actual lever that drives institutional gold positioning. Here is how that works. If inflation is running at 3.8%, but the Fed funds rate is sitting at, say, 5.25%, then the real rate, the actual return you get after accounting for inflation, is still positive. Money sitting in treasury bills is still, in real terms, earning something. Not much, but something. And when money in safe assets earns a positive real return, there is a cost to holding gold. Gold pays no yield. Gold produces no dividend. If you can earn a real return in treasuries and you hold gold instead, you are giving something up. That opportunity cost is the gravitational force that pulls institutional money away from gold, even when inflation is elevated. So when inflation came in at 3.8%, and the market interpreted that as a signal that the Fed would hold rates higher for longer, or possibly even hike again, the real rate either held steady or moved upward in expectations. And in that environment, the institutional calculus was, hold paper, not metal. That is the mechanical answer, and it is true as far as it goes, but it is also deeply incomplete, because it treats gold as a simple financial instrument, responding to a simple equation. And gold is not that. Gold has never been that. Let's go deeper. There are two gold markets. This is not a conspiracy theory. This is a structural reality that anyone who has studied the London bullion market or the COMEX futures market for more than a few weeks will understand clearly. There is the paper gold market. This is the market of futures contracts, ETF shares, swaps, forwards, and financial derivatives, instruments that are denominated in gold, that rise and fall with gold's price, but that do not require the actual delivery of physical metal. The COMEX in New York is the most liquid of these markets. On any given day, the notional value of gold traded on paper markets dwarfs the actual physical gold that changes hands in the world. Some estimates of the ratio of paper gold to physical gold have run as high as 100 to 1, though precise figures are contested. What is not contested is that the price of gold, the number you see on your screen, is primarily set in the paper market. And then there is the physical gold market. The market for coins, bars, central bank reserves, industrial uses, and the centuries-old private wealth preservation that flows through bullion dealers, sovereign treasuries, and family offices across Asia, the Middle East, and increasingly the global South. These two markets have been increasingly diverging in behavior, And that divergence is one of the most important financial stories of our time, one that receives almost no mainstream coverage. When Western institutional traders, responding to real rate dynamics and Fed policy signals, sell paper gold futures, they push the paper price down. The number on the screen falls. The headlines say gold dropped. But on the other side of the world, in Shanghai, in Dubai, in Istanbul, in Mumbai, physical gold is still being bought, quietly, consistently, at a pace that, if you zoom out and look at the data, is historically unprecedented. The World Gold Council has published demand data showing that central bank gold purchases in recent years have hit levels not seen since the early 1970s, the era when the Bretton Woods system was collapsing and the world was renegotiating the monetary order. In 2022, central banks globally purchased over 1,100 tons of gold. In 2023, they purchased over 1,000 tons again. These are figures that, if you encountered them without context, would seem extraordinary, and they are. But they have been consistently underreported, underanalyzed, and underappreciated by the mainstream financial press. So here is the paradox you need to sit with. On the day that inflation prints hot and gold's paper price falls, central banks, the very institutions that manage sovereign currencies, are in the market buying physical gold at record rates. Why would they do that? Why would the institutions that issue and manage fiat money be systematically accumulating the one asset that sits outside the fiat system? The one asset that, by its very nature, is a statement of skepticism about the monetary system they operate. That is the question at the heart of this story, and the answer requires us to zoom out, far out, from one inflation print, from one day's trading, from one candle on a chart. We need to talk about the dollar. Specifically, about what is happening to the dollar's role in the global monetary system. The United States dollar has been the world's reserve currency since the Bretton Woods Conference of 1944. That status, the fact that global trade is predominantly invoiced in dollars, that commodity prices from oil to copper to soybeans are set in dollars, that sovereign nations hold dollars as their primary reserve asset, confers on the United States an extraordinary and historically unique privilege. The economist Barry Eichengreen has called it the exorbitant privilege. The ability to run persistent trade and fiscal deficits without the currency collapse that would afflict any other nation doing the same thing, because the world needs dollars to function. But reserve currency status is not a law of nature. It is a geopolitical consensus. And that consensus has been showing structural cracks for years that have accelerated dramatically in recent months. The weaponization of the dollar after the Russian invasion of Ukraine in 2022 was, depending on your perspective, either a necessary and appropriate use of financial power or one of the most consequential strategic miscalculations in monetary history. The decision to freeze approximately $300 billion in Russian sovereign reserves held in Western financial institutions sent a clear and unmistakable message to every government on Earth. Dollar reserves held in the Western financial system are not unconditionally yours. They are conditional on your political alignment with Washington. Governments noticed, central banks noticed. Nations that had been holding dollars as the bedrock of their reserve systems began quietly, systematically asking, what is the true risk-free asset? What do we actually trust? And the answer that many of them arrived at, not publicly, not in press conferences, but in the actual allocation decisions reflected in IMF data and World Gold Council statistics, was gold. Because gold held in your own country's vault cannot be frozen, it cannot be sanctioned, it cannot be seized by a foreign power through the messaging system of the global financial network. It is, in the most literal sense, the only major reserve asset that carries no counterparty risk. Poland bought gold, Hungary bought gold, Singapore bought gold, Turkey bought gold, aggressively. China has been reporting consistent monthly additions to its gold reserves, and many analysts believe the official figures significantly understate actual Chinese gold accumulation, because purchases can be routed through the People's Bank of China in ways that do not immediately appear in reported statistics. This is not a fringe reading of the data, this is the data, and yet when you watch the gold price on the day of a US inflation print, you are watching something almost entirely disconnected from this multi-year structural shift. You are watching Western institutional traders respond to Western monetary policy signals in a market that they dominate in terms of short-term price discovery. The paper tail wagging the physical dog. Let's talk about what 3.8% inflation actually means, because the number itself deserves interrogation. The Consumer Price Index is a constructed measurement. It is not a measurement of how much more expensive your life has gotten. It is a weighted basket of goods and services, with weights determined by the Bureau of Labor Statistics based on estimated average consumption patterns, using a methodology that has been revised significantly over the decades, in ways that, depending on your analytical perspective, have made the headline number progressively less reflective of lived inflation experience. Shelter costs are a well-documented example. The CPI uses a measure called owner's equivalent rent, an estimate of what homeowners would pay to rent their own homes, rather than actual home prices. This has significant methodological implications. When home prices spiked dramatically in 2020 and 2021, owner's equivalent rent lagged the actual market by 12 to 18 months, meaning the CPI understated housing inflation as it was occurring. Now that rent growth is decelerating, the same lag effect is working in the other direction, potentially making shelter costs appear more persistent in the index than they are in the real market. The point is not that the BLS is engaged in deception. The point is that any single number purporting to capture the inflation experience of a $27 trillion economy across 330 million people with wildly different consumption patterns is, by definition, an approximation, an abstraction. And yet that single number, the 3.8%, moves hundreds of billions of dollars of financial assets in milliseconds. It triggers algorithmic trading responses. It reshapes interest rate expectations. It causes gold to fall on a day when, by any reasonable structural analysis, gold's fundamental case is stronger than it has been in a generation. There is something almost philosophically disorienting about this if you think about it long enough. Let's go further. Let's talk about what the Federal Reserve is actually dealing with. The Fed has one of the most difficult mandates in the history of central banking. It is trying to bring inflation back to 2% in an economy where the inflationary pressures are not entirely, or even primarily, monetary in origin. They are structural. They are demographic. They are supply chain related. They are fiscal in nature. Consider, the United States federal government ran a deficit of over $1.8 trillion in fiscal year 2023. In a period when the economy was not in recession, in a period of historically low unemployment. This is not a recession-fighting deficit. It is a structural deficit, driven by mandatory spending on Social Security, Medicare, Medicaid, interest on the national debt, and defense, categories that are politically almost impossible to reduce meaningfully, regardless of which party controls Washington. The Congressional Budget Office projects that interest payments on the federal debt will become the single largest line item in the federal budget within this decade, surpassing defense spending, surpassing Social Security in terms of annual cash cost. The debt itself is now over $34 trillion. At current interest rates, the annualized interest cost is running above $1 trillion per year. Let that settle for a moment. The United States government is now spending more than $1 trillion a year simply to service the interest on its existing debt. Before it builds a road, funds a school, pays a soldier, or sends a Social Security check. This is not a fringe doom narrative. These are CBO figures. These are Treasury Department numbers. This is the fiscal reality of the world's reserve currency issuer. Now here is the question that gold is quietly asking, and that the paper price of gold on any given day cannot fully express. How does this end? There are really only a limited number of paths from here. You can grow your way out of it, but the growth rates required to meaningfully bend the debt trajectory at this level of accumulated debt are historically extraordinary. You can cut spending, but the political economy of doing so at the scale required makes this essentially theoretical. You can raise taxes, but again, the scale required and the growth impacts create their own constraints. Or you can inflate. Not hyperinflate, not Weimar Germany, but allow inflation to run persistently above the official target for an extended period, gradually eroding the real value of the debt stock. Financial repression, the suppression of real interest rates below the inflation rate to transfer wealth from savers to the sovereign debtor, has been used repeatedly throughout history to manage excessive debt burdens. After World War II, the United States and United Kingdom both employed this strategy over decades, holding nominal rates artificially low relative to inflation and gradually working down their war debt ratios. The question is not whether this is possible. It demonstrably is. The question is whether gold knows it is coming. Because if the long-run path is one where real interest rates are systematically held below zero to manage an unmanageable debt load, where the purchasing power of the dollar is gradually but consistently eroded over years and decades, then gold at its current price, in the context of a falling paper market response to one inflation print, might be one of the great disconnects in modern financial history. Let's talk about China specifically for a moment because it deserves more than a passing mention. China's relationship with gold is multifaceted, strategic, and long-term in a way that Western financial markets consistently fail to appreciate, because Western financial markets operate on quarterly earnings cycles and algorithmic trading horizons measured in milliseconds. China has been systematically increasing its domestic gold production, its gold refining capacity, and its gold reserve accumulation for over a decade. The Shanghai Gold Exchange has been growing its physical delivery volumes. China has been central to the development of non-dollar trade settlement mechanisms with nations across Asia, Africa, the Middle East, and Latin America. The BRICS grouping, Brazil, Russia, India, China, South Africa, and now a growing list of new members, has been in active discussion about the possibility of a commodity-backed trade settlement mechanism. Now, to be precise, a gold-backed BRICS currency is not imminent. The economic and political complexity of such an arrangement is enormous, and there are serious structural obstacles. But the directional signal, the fact that the world's largest population, the world's largest manufacturing economy, and a growing coalition of nations representing a majority of global GDP by purchasing power parity, are actively exploring how to conduct trade outside the dollar system, is not nothing. It is one of the most significant monetary developments since 1971, and gold is at the center of it. Because if you want to credibly settle trade outside the dollar system, you need a neutral reserve asset. An asset that no single nation issues and controls. An asset with millennia of recognition as a store of value. An asset that, almost definitionally, leads you back to gold. The paper gold market in New York does not price any of this on a daily basis. It prices real rate expectations and positioning by Western institutional funds. But the physical gold market, the tons quietly moving from west to east, from paper to vault, from financial instrument to strategic reserve, is pricing something entirely different, something longer term, something more fundamental. Let's bring this back to you, to the person watching this, trying to make sense of a market that seems to operate by rules designed to be opaque. What should you actually take away from all of this? First, understand the difference between price and value. On any given day, the price of gold is set by paper market dynamics, institutional positioning, algorithmic responses to data releases, real rate calculations, and the flow of futures contracts. This price can move sharply in directions that appear to contradict gold's fundamental investment thesis. That is not a sign that the thesis is wrong. It is a sign that short-term price discovery in financialized markets is a deeply imperfect mechanism for reflecting long-term structural realities. Second, watch the physical market, not just the paper price. Watch central bank demand data from the World Gold Council. Watch the flow of gold from COMEX warehouses and London vaults. Watch the premium that physical gold commands over paper prices in Asian markets. When that premium widens, it is a signal that physical demand is outrunning paper supply. These are the data points that reflect what the institutions with the longest time horizons and the deepest sovereign interests are actually doing. Third, take the fiscal trajectory seriously. The mathematics of the U.S. debt situation are not a political opinion. They are a balance sheet, and the options available to manage that balance sheet, all of them, including the more benign ones, involve some combination of inflation, financial repression, or dollar devaluation over the long term. None of those outcomes are good for the purchasing power of paper money. All of them are historically supportive of hard assets. Fourth, understand what you own when you own gold. Physical gold, bullion coins, bars held in your direct possession or in allocated storage, is the only asset that has no counterparty risk. Every other asset in your portfolio is simultaneously someone else's liability. A bank deposit is a liability of the bank. A bond is a liability of the issuer. Even an ETF carries the counterparty risk of the fund structure and the custodian. Gold in your hand is simply gold. This is not an argument for putting your entire net worth in gold. It is an argument for understanding what gold uniquely provides that no other asset can provide. And fifth, perhaps most importantly, practice epistemic humility about what the daily price of any asset actually tells you. Markets are extraordinary information aggregating mechanisms, but they are not oracles. They are subject to distortion by leverage, by institutional incentive structures, by regulatory frameworks, by political pressures, and by the simple human tendency toward short-termism. The fact that gold fell on a hot inflation print does not mean the market has correctly assessed gold's long-term position in an evolving monetary order. It means that on that day, the traders and algorithms that set the paper price decided to sell. Those are two very different things. Here is the view from a higher altitude. We are living through one of the most consequential periods in monetary history since the collapse of Bretton Woods in 1971. The reserve currency system built around the dollar is under structural pressure from multiple directions simultaneously. Fiscal excess, geopolitical fragmentation, the active de-dollarization efforts of a growing coalition of nations, and the gradual erosion of confidence in Western financial institutions as neutral custodians of global savings. These are not overnight phenomena. They will not resolve in a single quarter or a single year. They are decade-scale developments playing out in slow motion. Gold has been the answer to monetary disorder for longer than any modern financial institution has existed. Not always the perfect answer, not without volatility and frustration along the way. But in the long sweep of monetary history, gold has preserved purchasing power across currency collapses, debt crises, wars, inflations, and regime changes in ways that paper assets have not. The question, why did gold fall on a hot inflation print, has a short answer: real rates and institutional positioning. But it has a longer answer, because the paper market for gold in the short term, dominated by Western financial institutions responding to Fed signals, is increasingly disconnected from the physical market for gold in the long term, driven by sovereign wealth accumulation and a global reassessment of what genuine monetary safety actually looks like. The short answer is satisfying in the way a financial headline is satisfying. It gives you a cause and an effect. It fits on a chyron. The long answer is unsettling in the way that genuinely important things are often unsettling. It asks you to question what you think you know about how money works, about how prices are set, about what safety actually means in a world where the financial system's foundations are shifting in ways that most daily market commentary is constitutionally incapable of capturing. When central banks, the institutions that manage sovereign currencies, are buying gold at historic rates while the paper gold price falls in response to their own policy signals, you are watching two completely different markets tell two completely different stories about the future. One story is short, one story is long, and they cannot both be right. The daily market cannot see a decade, but history can. And history says that when monetary systems are under structural strain, when debt levels reach the point where the mathematics of service become absurd, when geopolitical fragmentation disrupts the consensus that makes reserve currency status self-sustaining, in those moments, gold is not a trade. It is not a futures position. It is not a portfolio allocation to be adjusted based on the real rate implied by the overnight index swap market. It is a form of memory. The financial system's memory of what money was before it was someone else's promise, before it was a ledger entry, before it was a liability on a central bank balance sheet that might, on a day when geopolitical calculations shift, be frozen. So yes, inflation hit 3.8%, and gold fell. And somewhere in a vault in Beijing, in Warsaw, in Singapore, in the bowels of a central bank that has been watching the paper price with something between amusement and anticipation, another ton was quietly added to the reserve. That is what they are not telling you, and now you know.